Hi, this is Pete Birchler of StockMarketAlchemy.com. Today is Monday, June 10th. I'm going to do a very brief review of the stock market today, look at a couple charts, and give an opinion on some scenarios of what to look for here. The first chart we're looking at, this is the total put-to-call volume ratio. So the higher the pink line on this chart rises, would be indicative of more puts being traded, more fear in the market. And so it's a contrarian indicator, and one of the ways I use this is to look at where the average put call volume is relative to some standard deviation bands. And over the last week or so, we've seen a couple readings outside of this blue one standard deviation band. And during an uptrend, those will typically be very good buy setup points for a continuation of the uptrend. So given that we've seen that here, I think we need to respect this as a potential buy point for a continuation of the bull market. However, the flip side of this is that once we do see a reading like this, prices really should hold without much further downside. And if you think about after a market becomes extended to the upside, initially once you start to see the price break to the downside and fear enter the market, as that starts to get larger or more intense than the little multi-day corrections along the uptrend, you will see these ratios tend to rise even higher. So a spike like this can occur right at the beginning of a correction, and in that case we still will often see the market rebound for several days. But if we do see a rebound, as we currently are in here for the last 3 days, followed by a break to lower lows for a correction, that can be a tip-off that the uptrend is over, or at least the leg up is over, and we're going to experience a correction. So that is something to look for here. If Friday's let's move to a chart of the S&P 500. So if Friday's low holds on the S&P 500 here at around the 1600 level, and prices maintain above that, I think we need to give the upside the benefit of the doubt. However, if after this significant rebound, after the put-call ratio and the VIX spike significantly, if we do see prices come back down below Friday's low, then I do believe we would be likely to experience some significant further downside. How much is a question? A typical correction in the markets historically would be somewhere around 10 to 11% total correction in maybe 1 to 2 months. So given the high here up around 1690, at 10% correction off of that would be roughly 170 points. So it could take the market back down close to this 1500 level for a normal, relatively typical correction if we do see Friday's low broken. So that's what I would look at. And in addition to that, this decline off of the May 22nd high has been longer in time than any of the other corrections since this November low. So at 10 days it was longer than any of these other corrections. It was also larger than any of these other corrections. So those are some tip-offs that we either have seen a nice healthy pullback in a continuing uptrend, or this again would be an indication that we are seeing the balance start to tip towards the downside. And again, for further confirmation of that, I would suggest that a break of last week's low would be a good indication of that. Let me move to some other charts now and briefly show the technical picture here. I think there are a couple things to watch for on the technical indicators. When we look at a MACD chart currently, hang on here just a second. If we currently look at a MACD chart, this is the Dow. we haven't really seen your classic divergence pattern coming into this high. We've seen a relatively extended trendy type of MACD formation here without any moves back below the zero line here on the Dow. What I think would be a more typical topping scenario is for price to move up and slightly overshoot these highs here with somewhat of a sharp MACD bearish divergence before any topping type of action. And again, I think the protective stop point for this uptrend, if you look at the uptrend here in the channel that's kind of drawn on the chart, we have some significant multi-day pullbacks here, and I think if one is long the indexes here, this would be now a logical stop loss point would be to have a stop below this level here, possibly even with some type of a trailing mechanism. So as prices move higher here, it could adjust the stop higher as well. So that's something to look for on the MACD. If we do see prices move above the May highs, is to look for a divergence formation, and then again monitor to see what type of strength at the downside we would see off of any type of high at that level. Moving to a weekly chart of the S&P 500 here. This is a daily chart. Let's move to a weekly chart. The weekly chart is showing prices above its parabolic SAR level here, and the momentum is above its average and above the zero line. So we do have indications that this still may be a stable uptrend here, but if prices move back below, again, last week's low, at some time by next week, we would be close to, again, a parabolic SAR sell trigger, which could be significant in that many of the recent highs and legs up, once they've hit that parabolic trigger, they've had trouble sustaining upside. Now, we did see a false trigger here in April, followed by a sharp move higher, but that pattern may not replay itself if we do see that happen again here. So that's something to maintain on your chart just on a mechanical type of system to look for, is that parabolic SAR level. Now, one other thing I did want to show is the Mcclellan Oscillator, which is basically a measure of breadth in the market, and look at what that's telling us here. Similar take-home message here in that the Mcclellan Oscillator reached a relatively low level, basically corresponding to the low we saw in November of 2012, which was the low of that correction from September to November. And there are really three scenarios I would look for here of the meaning of this low reading. The first can be in a stable uptrend, we're going to see a sharp spike low, and that low will not be touched or exceeded again, and prices will continue higher. That would again favor a stop loss being placed below last week's low. Another scenario is we see this spike low, we see a rally higher, and then we see, as far as price goes, we would see a brief undercut of the low, but with a higher low in the Mcclellan Oscillator. So we see a divergence pattern here between breadth and price over the next several days or week or two. The third scenario would be that this initial sharp move down is basically just the first move down in a correction, and oftentimes we will see a rebound for several days after this type of reading. So we may see a rebound, but then if we do see prices come down and make a significant lower low, then that would possibly lead us into several more weeks of correction to the downside. So in all of those scenarios, I do think last week's low is a significant point. However, if we do see a divergence pattern after last week's low is broken and then it's regained quickly, that would be probably a bullish chart pattern set up for a buy point there. So that would be the one scenario to look for as far as kind of a fake out scenario fake breakdown followed by a reversal with a divergence on some of these indicators could be a significant type of buy point there. So that's my take on the market here. As far as the commitment of traders data, I do think I have those charts pulled up here. Nothing really different on the COT data here. Basically, we are still seeing the commercial traders having a very heavy net short position, near record net short position in the stock indexes, which my opinion is that over the longer term that is probably a bearish factor. However, that may take several months or even more than that to really turn the tide. As far as on a shorter term basis, we are seeing the commercial traders start to move or lessen their short position, particularly over the last reporting period, over the last week, but it's not to the point where we typically see a corrective bottom. We will often see this line here, this blue line, move up above this 100 level here. So if we do see some further buying or reduction of the short position over the next couple weeks, that's something we would want to monitor, because at that point we would be getting to a level where the commercial traders are buying relatively rapidly. Now, they do have a lot to sell, so that doesn't necessarily mean the market couldn't decline further. But we want to see when they start to buy rapidly. We want to be alert for any type of long signals to indicate that it may be overdone to the downside, or the correction may be done. So I don't think there's a whole lot new to gather from this information. I would again suggest that last week's low could be an important point if broken to the downside based off of this data. So that is all for this update. I will update here as appropriate over the next several weeks, depending on whether we continue to see this market move higher and look for a further developed topping pattern, or whether we see last week's lows broken. I may update again and give my take on what is happening there and the likelihood of a continuation versus kind of a false breakout to the downside followed by an upside reversal. So with that, I'll let you go. All the best to your trading.